Hello, everyone. Nice to see you again uh, in our series on risk management topics. And our discussion point today would be the liquidity risk. As uh, as we know, liquidity risk is very important, very crucial to every firm, but in particular to financial institutions because like the uh, liquidity position could really determine whether a financial institution could survive and also grow in the future. So if we can imagine like firms in typical industries or in common industries like manufacturing or services, uh, of course, liquidity position or liquid assets are still important, but the role of their fixed assets or capital assets would be more dominant. If I give you an analogy, we are thinking about a manufacturing company. So the factories, the like high class equipment, right? Their other capital assets would be would be the sources of money generating activities or the sources of productivity. So this is not to say that current assets or liquid assets are not important to manufacturing or services firms or other firms from other industries. But we're just saying that the uh, capital assets or their productive assets, their fixed assets would be again the major or the dominant power or dominant sources of their productivity or money generating activities. So uh, let me give you an analogy. Uh, if you ask anyone about maybe a car, right, automotive, what is the most important component of a car? So I'm sure that maybe more than 90% will rightly answer that the most important component of a car is its engine, right? Rightly so, right? So engine is the most important component, right? And it's rightly so because it determines the actually it's like the heart of the car. However, if you think about it, if you drive a car and you don't maintain the car properly or you carelessly, just have the car and drive it without checking, and the driver of the car might experience an accident in the middle of the streets, not because of the broken engine, but maybe because of some other problems, maybe tire problems, maybe some suspension problem, and all other things. So the car could die out in the middle of the street, not because of not because of a problem with its most important component, but with other peripheral components. This is a similar situation to an organization, right? So you might have like really good fixed assets, good talents, strong other capital assets, and so on. But if you don't manage your current assets or your liquid assets well, then the organization uh, might become dysfunctional, might die out in the middle of its journey, not because of uh, the bad productivity or bad prospect, but because they don't pay attention to the details, right? They don't manage the current assets well. Okay, so this I think very important thing to bear in mind, right? So although current assets may not be seen as uh, important as the capital of fixed assets, but still, right? If we don't manage the current assets well, then the organization might not ever reach its designated you know point or its target. So now let's move back to financial institutions. Liquidity position is even more resounding, more crucial, right? Because financial institutions are dealing with the channeling of funds, receiving funds and then channeling the funds to other entities or other entrepreneurs. So it's even more, more important, right? Uh, of a bigger concern, right, to the financial institutions than to other types of firms. So let's go into the details. Okay, so liquidity risk for financial institutions. If you see here in the slide, some financial institutions will be exposed or will be faced with higher exposure, for example, depository type, right? Depository institutions like banks. Uh, and you see toward the end of our discussion, you see why depository institutions such as banks are exposed to a higher level of liquidity risk compared to other types of financial institutions. So other types of financial institutions, such as life insurance, so they are facing the more moderate type of exposure of liquidity risk. And even you see that mutual funds, hedge funds, pension funds, and general insurance or property casualty insurance companies, they are even having like, a lower exposure of liquidity risk. So in essence, we are saying that financial institutions, again, are always facing the liquidity risk, but some types of the financial institutions are exposed to a higher level of liquidity risk. Now, causes of liquidity risk. So you can see that it could come from two sides. Right, the first side is the liability side, the financing side, and the second source is the asset side, right, or the investing side. So you can see here liability side occurs when depositors or policyholders cash in claims. So suddenly, you see, uh, a lot of like depositors withdraw their money. Now, as you know, as a financial institution, for example, a popular financial institution such as bank, so we receive deposits, right? We receive core deposits from our depositors. Of course, we can also borrow money, right, in the form of issuing bonds, issuing notes, and some other sources, commercial papers, and some other things. But again, the core financing to the bank, to our bank, would be the core deposits. So we receive deposits from depositors, and then we channel the funds. Right? We provide loans to entrepreneurs, to corporations. Right? So this is the nature of our business. So uh, one primary or particular cause of liquidity risk would come from the liability side. So in normal situations, we could imagine that uh, like normal withdrawal amount or common withdrawal pattern will take place, right, in normal economic situation. For example, we have like corporate clients, they will put money, they'll put like enormous or significant amount of money on, let's say, maybe 15 every month, right? So they're putting money from time to time, but a lot of money would come in maybe on 15. This is just an example, okay? But on 25th, so let me show the screen. Okay, I repeat again, right? Some financial institutions have a higher exposure, some have more moderate exposure, and some are exposed to a lower level of liquidity risk. We talked about it, just forgot to show the screen. Now we have the PPT screen. Okay, now the first, again, the first cause of liquidity risk or the first source of liquidity risk is from the liability side, right? So again, as a financial institution such as a bank, we will receive a lot of deposits, right? So in normal economic situation, we could estimate, we could predict, of course, not entirely accurate from time to time, but at least we could make a safe and common prediction that a lot of money would come in on certain date, and that amount of money will go out on maybe certain dates. For example, on 25th, there are a lot of payments would be made to employees, right, for their salaries, also for repayment of debts of those corporations and so forth. So we know that on 25th there will be some withdrawal, but under the normal economic situation, we could predict that quite accurately. So it will not create any liquidity rush or liquidity problem, right? Liquidity situation. It will not pose the threat on under the normal economic situation. However, in difficult periods, maybe such as this, we are having a healthcare crisis right now, that would also affect the global economy and also other sectors. So there's a threat, right? There's a risk of uh, facing or seeing a run or rush, right? So they might just withdraw a lot of money at a short period of time, uh, creating like financial or liquidity difficulty for financial institutions. Okay, so liability side. So this is a threat or a potential problem of uh, a significant withdrawal of money at one particular time by our depositors. What about the asset side? Asset side liquidity. This could also happen when we have to actually materialize or we have to fulfill our promises. So as you know, financial institutions such as banks are facing stiffer competition from time to time, right? We, if we read from the history or from any other sources about banking industry, maybe 50 years ago, the competition was not that tough, right? And every bank had enough cake, right? Enough market share to enjoy, to uh, really benefit from, and to proliferate. But as the time passes, right, the world keeps changing with advancing technology, with stiffer competition with respect to products, customers, and also other developments. And with the coming of fintech, it's quite challenging and also threatening to the traditional financial institutions. Right? So, uh, no, to prevent themselves from relying too much on not, interest income, right? Now they are also pursuing the non-interest income or fee-based income. Right? So one of the most you know, important and also interesting uh, fee-based income sources would be to give, for example, commitments apart from other sources such as writing letters of credit or issuing guarantees to projects and other things. Uh, but the loan commitment is one of the favorite sources of fee-based income, right? So because by simply promising loan commitment, we could get the fee, right? So we have like two potential benefits, right? If we give loan commitments to many corporations, right, to many entities, many clients, then first we get the fee, right? We get the what's that the uh, commitment fee. So if it turns out that those clients don't act on right act on our promises, then at least we'll get the fee, right? The commitment fee. However, if our clients do materialize our promises, then uh, we will provide the loans, right? And the loans will carry interest income. Okay, so there are two sides, uh, both are beneficial and also productive to our financial institutions. So we get both ways, right? Again, if the clients uh, receive our promises, our commitments, but it turns out that they don't uh, execute and they don't act on our promises, then at least we'll get the commitment fee. But if they do materialize, they do execute on our promises, they execute the option, then we will get interest income, right? Because we really provide the loans to our clients. So this is very interesting one, right? And it has been becoming, like an important part of a financial institution's income. But here's the problem, or potential problem. Uh, if we if we give too many commitments, right? If we offer or promise too many commitments to too many clients, and suddenly a situation warrants that they execute all our promises or all our commitments, then we might be in a difficult situation to fulfill the promises. I know this is a good thing to us, but right, another uh, important thing that we have to fulfill is we have the liquidity to provide the loans, right? So bear with me again. If we give a lot of commitments or promises, and because of the industry situation, the business cycle, or the economic situation, they execute on our promises at the same time, we'll need a lot of cash, right? A lot of liquidity to fulfill our promises. Of course, we are happy by providing the loans because we will get the interest income. However, can we fulfill our promises? That's very important, right? It's hardly, almost impossible to imagine that you tell your clients when they come tomorrow to execute their options, and you tell them that we don't have the cash right now, please come back next week. Then that will ruin your reputation, right? That will tarnish your business and reputation forever. So it's impossible to do that. So what can you do? If they do come tomorrow, then you have to find a way to provide the cash, right? Provide the loans. Maybe you have to borrow somewhere else. And remember, by borrowing somewhere else, you have to pay the what's that? The borrowing cost. So that would certainly diminish the benefit, right? The gap that you can get from providing the loans and borrowing money from another source, right? So it's really a dilemma, delicate problem to a bank or a financial institution in general. Because on one side, you know, uh, we love the fact that we could provide loans to many clients because they execute the options, they execute our promises. But on the other hand, uh, we must be ready to have the the cash or the liquidity to provide the loans to them. Otherwise, we have to borrow somewhere else with a high cost of capital or high borrowing cost. Okay, so liquidity side, sorry, liability side liquidity risk. Again, we might rely a lot on demand deposits and also on passbook savings. I mean the common savings, right? Because again, naturally, a bank, right, as a financial institution, as a depository institution, relies on core deposits, right? We call it core deposits, like the demand deposit, time deposit, right? Passbook savings, something like that, right? And this one, we just talked about it. Depository institutions need to predict the probability distribution of the deposit drains. So again, under normal economic situation, we could safely predict that on certain dates, there will be a lot of incoming cash flows from the core deposits. But on certain dates, we have to be prepared or ready to disburse the money because many of our depositors will withdraw money to repay their debts or to pay their salaries and so on. And be careful as well with this one. Seasonal effects. Some periods, a certain month, we'll see an increasing demand for cash, right? So most of our depositors will withdraw money, for example, during religious celebrations, end of the year celebrations, some other festivals, right? So now we'll see the approaches that we could take, right? The approaches that we could choose to managing the liquidity risk. So at least there are two management styles. The first one is purchased liquidity management, right, or purchase liquidity approach, and the second one is store liquidity approach. Right? So we'll see each of them. So before we go into the technical estimation of technical details, so we see that every bank would choose its own policy with respect to uh, how they manage, how they arrange the channeling of funds, right? Receiving deposits and then giving or providing loans to our clients. So, for example, we see here Bank of America is yeah, the biggest bank in the US. So the borrowed funds to total assets is bigger, right, than a smaller bank such as Northern Trust Bank, right? Also, loan to deposit. So borrowed funds, you can imagine borrowed funds mean non-core deposits. So borrowed funds uh, refer to, for example, bonds payable, right? You issue bonds, you issue many series of bonds, uh, commercial papers, notes, right? And yeah, other types of non-deposit borrowings, right? So we call it borrowed funds. So as a bigger bank, the proportion of borrowed funds to total assets is bigger for Bank of America compared to Northern Trust Bank. Also, loans to deposit. See loans to deposits ratio, right? The for Bank of America is 68% and 36 only for Northern Trust Bank. So loan to deposit ratio is tied to a regulation in every country. So every country will arrange the minimum and maximum ratios for this one. Yeah, for example, in a country like Indonesia, loan deposit ratio usually ranges from 78% to 92%. So the regulators will do this arrangement uh, dependent upon the necessity and also the situation, the monetary situation in that particular country. Right? If we have a range, a certain regulation about the range, if a financial institution or a bank is having a loan to deposit ratio below the minimum range, then the financial institution will be penalized, will be sanctioned. On the other hand, if it reaches a level above the maximum point of the range, then the financial institution or the bank will be penalized as well. So it should be within the range. Then you see core deposit, the total assets. Uh, Also, the Bank of America is more dominant. And now loan commitment to total assets ratio. So commitments that we make compared to the total assets. You see, a bigger bank will have more like loan commitment activities, like loan commitment giving or writing. Okay, so now we go into some scenarios. So balance sheet now before a liquidity problem appears. So it's a normal situation. You see the assets are 100 with co-deposit of 70, with non-deposit borrowing or borrowed funds like bonds, commercial papers, um, notes, and other liabilities of 20, so 100, right? So suddenly the drain takes place, right? A liquidity problem emerges, and what situation is it? Is liability side problem, right? So from 70, you see here, from 70, uh, there's deposit drain here. there's a deposit drain. Suddenly, a lot of our depositors are withdrawing money. So 70 suddenly drops to 65. This could create a shock, right? No, because of the seemingly rush or run that's happening quickly. So what can we do? So the first method, the first approach is the purchase liquidity. So we call it a purchase liquidity approach because uh, we try to borrow more money, or we call it purchase, right? So we try to borrow money, additional money, only if uh, the liquidity problem appears. So without any liquidity problem, we do nothing, right? We do nothing. So we only act upon it, or we only, do something, execute the policy only if there is a liquidity problem. So what are we doing here? So because of the drop, right, 65, so we increase the borrowed funds. We increase the borrowed funds from 10 to 15. Okay, so this is called purchase liquidity approach. So what is the benefit or the main advantage or advantages of doing this? The main advantages, of course, is efficient because you do nothing. You do nothing until something happens, right? Until the liquidity problem appears. So without any liquidity position, liquidity problem, you essentially do nothing. So it's quite efficient, right? But what is the major disadvantage, major weakness of this approach? I could say it this way: it's dangerous, right? It's dangerous if the you know bad economic situation does appear. You might not have the chance uh, timely in an appointed time to be able to borrow the the required funding, right? So imagine again, right? If economic crisis, uh, the looming economic crisis does materialize into the real economic crisis, then do we have a chance to increase our borrowing from 10 to 15? That's really big question mark, right? The uncertainty is so big there. So nobody could guarantee that you can get the difficult borrowing in a difficult time when everybody also wants or needs cash, right? And even even if you can finally find sources of borrowing, right, to borrow additional funds to cover the deposit drain, it might come with a very expensive cost, right? Maybe the borrowing cost would be very high, right? Okay, imagine in 1998 when a big banking and economic crisis happened in Asia. In some Asian countries, the interest rate even soared to like 60% a year. 60%, 60. Can you imagine, right? Even with the interest rate of 60%, not many people were, willing to put their money back into the banking industry, to the banking sector, because everybody didn't trust the banking sector, didn't even trust the governments at that time. So they were holding cash and also gold and some other current assets. Right? So very difficult to find borrowings in a difficult time such as in the crisis period. So what sources of borrowing can you have? The traditional one to a financial institution, especially a bank, Fed funds market, right? Fed funds market, and or repo market, repo repurchase agreement. The Fed funds market, you could borrow, short-term borrowing from another bank, right, or another financial institution, and the interest rate charged would be the Fed funds rate. Right? And what about repo agreement, repurchase agreement, repo market? So repurchase agreement, you can imagine, as the name suggests. So we need money, so we borrow money from another institution, and as guarantee we give them, for example, the T-bills or government securities, right? So the government securities are the like the collateral with the agreement with again with the agreement to buy back or to repay our borrowing. So let me repeat about the repo market, repo purchase agreement. So we need money, so we borrow money from another institution, right, or another bank. So as guarantee or collateral, we put the government securities that we have. So this borrowing is tied or is followed up by an agreement to get the government securities or the collateral back. So it means that we will repay our debt within a short period of time, maybe 2 weeks, maybe 1 month or something like that. Right? So a short period of time. That's why we call it repurchase agreement, right? So we sell it or we put as collateral with an agreement to get it back or to repay our debt within a short period of time. Another source is managing the liability side, right? Okay, to preserve asset side of the balance sheet. See some facts here. Borrowed funds likely uh, will be at a higher rate, right? Especially if we need the additional borrowed funds at like difficult in a difficult situation or under difficult scenario. Okay. So the second approach is the stored liquidity. Stored liquidity. So what does it mean by stored liquidity approach? So under the stored liquidity approach, we intentionally hold excessive amount of cash or liquid assets to prepare for the liquidity, difficult liquidity position or difficult liquidity period. Okay, so we intentionally or we deliberately hold excessive amount of liquid assets such as cash. So what is the major advantage of this method? It's more conservative, it's safer because now you hold more amount of cash in case a uh, liquidity risk position comes to pass, right? Or this situation does appear. So you have the what's the excessive amount of liquid assets or cash. So what is the major disadvantage then? Of course, it's more expensive, right? Because now you're holding less productive assets. So you could have, lent out the money instead of holding the excessive amount of cash or liquid assets, right? So they are less productive assets, right? So by holding uh, a larger amount of non-productive assets more than what we usually did or we usually do, then actually we suffer from the productivity problem, right? So again, every approach will have its own advantages and also disadvantages. So we are not saying that this approach is better than the other, but we have to see the situation. In a looming crisis situation, I think the sold liquidity approach would be more appropriate and safer. However, in like the booming economy time, right, or period, then I think we have less concern about the liquidity problem or some market shock or bank run or something like that. So I think the purchase liquidity approach will be more efficient and also more beneficial to financial institutions during the normal or good economic times. Okay, we'll see an example here by doing the stored liquidity approach. Okay, so this is before the one on the top. is before the deposit drain. Now deposit suddenly drops to 65. So under the store liquidity approach, what will you do? You will drain your cash. So obviously, the amount of cash or liquid assets that you were holding, were excessive, right? Excessive. So 9 is obviously more than necessary. So if something happens here, the amount of deposit suddenly drops. So many of your depositors suddenly withdraw money within a short or period of time, or at one point in time. So you have to drain your cash from 9 to 4. So it's not a problem for you, because no, actually the amount of cash you were holding or you held were actually excessive. So you could drain it from 9 to 4 to balance the situation again. Okay, so what we have seen so far is the liability side liquidity risk, right? So the problem stems from the liability side. So now we're going to see the asset side. So once again, the asset side liquidity risk would primarily stem from the commitments or guarantees that we have been giving. Again, why a bank likes to write commitments or guarantees? Because uh, so they are handsome non-fee based sorry they are handsome fee-based income, right, or non-interest income that could be earned in this competitive era, right? So quite appalling, right? Quite compelling to financial institutions, because no, they could earn more money from the non-interest source, from the fee source. Right? So liquidity is from loan commitments, uh, primarily come from this one, right? Loan commitments. Right? And you can see here, you see the statistics, even in the United States, okay, it keeps increasing, and banks are considering the loan commitments and guarantees to be significant, more and more significant sources of non-interest income or fee-based income. So you see what is happening here before the asset side liquidity problem. This is after. So what is happening here? Suddenly, you see, your clients execute your promises, execute the loan commitments that you have written for them. From 91, it increases to 96. So it creates imbalance situation on your balance sheet. Now there are two approaches: the purchase liquidity and the store liquidity approaches. So under the purchase liquidity approach, what can you do? You increase your borrowed funds, right? So you borrow more. So again, under the purchase liquidity approach, you only do something when when the risk materializes, or when the risk does come to pass, right? Does come to play. So 10 to 15, right? What about the store liquidity approach? Under the store liquidity approach, you will drain your liquid assets. So you will use your excessive cash or liquid assets from 9 to 4, right? So again, the salient benefit of this approach would be it's quite safe, so you don't need to go anywhere. You know that if this happens, you have like excessive liquid assets that could cover the execution of your loan commitments or guarantees. Right? So you drain your cash because you have been holding an excessive amount of liquid assets or cash. Okay, so these two approaches. And you see another possibility of asset side liquidity risk would be the drop in the value of your assets, maybe your investments, right? Drop in your investment values. I see here your investment values dropped from 40 to 35. Okay, so now it's going down. This is quite common, right? Especially for maybe securities firms, right? Uh, we are holding a lot of securities, like stocks, bonds, government bonds, uh, mutual funds, right, and some other things. So your portfolio values drop from 40 to 35. So what can you do here? Under the purchase liquidity approach, again, you have to borrow more, right? So either this one, either you advertise more to find more core deposits, or you can increase this one if you want, right? Borrowed funds, you borrow more. You can borrow more from other banks, or from by issuing bonds or commercial papers or something else, right? So there are a lot of methods, right? A lot of ways, but the essence is you have to borrow more, right, to balance to cover the decreasing portfolio values that you are experiencing. What about this one, store liquidity approach? Store, so you have to drain your cash, right, from 9 to 4. And again, you have been holding like excessive cash or liquid assets. So if the situation warrants, then you have to uh, use your excessive cash or liquid assets to cover uh, the decreasing portfolio values. So asset side liquidity risk from, well, the portfolio values decrease. Right? If you are a financial institution, you're a securities firm, you are faced with this kind of position and risk every time, right? So of course, the uncertainty in the market will pose a threat on financial institutions every day, right? And this is interesting to see that technological improvements or advancement have increased liquidity in financial markets. This is true, right? Uh, However, you see, this one is quite dangerous, we could say, right? Herding behavior, the behavior to follow the uh, reference people or reference entities, especially to the naive investors. So they don't conduct any fundamental analysis nor any technical analysis. So they just herd, right? They just follow, especially again, they follow the reference entities or investors. So this is so too, right? When we have when we enjoy the technological advancement, liquidity would improve because we could control the channeling of money. Even we as individual and naive investors, like lay people, so we could use like a mobile phone to do anything. You can pay your tuition fees using the mobile phone. You can pay electricity bills, anything, right? Housing and everything. So liquidity would increase, right, to the financial institutions because now they could save time, uh, especially from the traditional checking policy, right? The check writing policy, like it was in the past, right? So it would take maybe 1 to 2 days to cash in the checks, to settle the transactions with other banks and so forth. Now with the technology, we could enjoy like higher liquidity, faster, liquidity management and something like that. However, here the herding behavior problem could be of a big caution and big concern to financial institutions, right? Because uh, we could not blame any reference people, people that people refer to, uh, because they are bearing risk, right? So financially and legally, we cannot blame. the reference people or reference entities, if they if their actions are followed by all other investors or all other depositors, right? So maybe I'll give you an example. During the crisis in 1998, back then, there were some people who were blamed heavily by certain countries because those countries were saying were assuming that many investors or many economic players simply followed those uh, reference people. But if you think about it, those reference people also took the risk by conducting or by executing their actions, right? So financially and also legally, we cannot blame those reference people. However, we have to admit that the herding behavior happens uh, because of the again because of the one because of the technology, but secondly because of the psychological no psychological uh, pressure and also hunches of the investors because they don't have any clue, they don't have the capabilities of conducting a fundamental analysis or technical analysis, so they just follow, right? So those reference people, although they uh, they are not guilty financially nor legally, but I would say that they might carry some guilt in the the uh, ethical point of view, right? Because they know that they should have known that their actions would be followed by other investors. So again, it's a delicate, what's that discussion, right? Even in the area of law, we cannot blame uh, the reference people or reference entities, although the herding behavior does take place. Okay, so we continue a bit. So sources and uses of liquidity. So every financial institution could list down the sources of liquidity and also their uses of liquidity. So you can see here sources of liquidity. That we have cash type assets, right? Sources of liquidity. We have cash type assets that could be sold quickly to get quick money, right? Uh, we have excess cash reserve, right? And maximum amount of borrowed funds available. Okay, so we can list down, the sources of liquidity if suddenly we are attacked by the liquidity risk or bad liquidity position, what sources we have, right, to gain quick liquidity. So it's here the cash type assets that could be sold quickly, right, to get quick cash, and amount of borrowed funds available, right? We start listing, the uh, potential creditors that we could borrow from, uh, maybe other banks, the government, right, through the discount window, or potential bond buyers, and all other sources. And excess cash reserve, right? And the uses of liquidity. So we have to be careful with this because uh, we have allocated some uses of liquidity from time to time, right? And we can see the amount, whether the sources of liquidity are 14.5 billion dollars, whereas the uses of liquidity, the projected uses of liquidity are 7.5 billion. So you can do it from time to time. So other measures, right? We're talking about measurement, peer group comparisons. Right? We can do the comparison with other similar institutions, maybe other banks or other financial institutions in general. And we can calculate the liquidity index. Liquidity index, you see here, the P of I as this price, right? So price of the ith asset divided by the price of the ith asset if the situation is normal, right? So let's see an example. So financial institution has two assets, right? So 50% in government securities and 50% in loans, right? The mortgage, right? Real estate loans. Okay, so for the first assets, so we see this is our estimate or projection, right? If we have to sell it quickly, we call it like fire sale. We have to sell it today because we need money within 2 or 3 days or within 1 week. So you will receive 99% of it, right? 99 out of 100. Okay, so you see the formula here. You will receive 99 cents per 100. Right? So this is to say that this is essentially saying that if you do the fire sale today, you have to sell it at 99. But if you don't sell it today, you wait until the appointed time of the maturity, then you can get the 100. Right? Okay, what about the second one? The mortgage loan that we have given to our clients. So if we need to do the fire sale, we need to sell the mortgage loan today, we'll be able to get 85. But if we wait until maturity, then we'll get like 92. So we can find the index here, right? So this is the weighted average, right? The weighted average. So the W is the wage. See the story there again, 50% uh, is invested on the government securities and 50% on the mortgage, right? So 50% times the ratio plus 50% times the second ratio. So we get like 0.957, pretty close to 1, right? So the liquidity position is considered relatively good to for this financial institution. So what if we change the scenario now? So instead of what's the previous example, 85, instead of 85, if you have to do the fire sale on the mortgage loan, you only get 65. 65 cents per dollar. 65 cents per dollar. So 65, and if we wait until maturity, we will receive 92. So the ratio will change, right? Because of the decreasing component for the second one, right? So now the index drops to 0.848, right? Still relatively high, but it's not as high as the previous scenario. Right? Okay, so it's very important uh, to have like good prices even during the fire sale. Okay, so the next one is we could estimate the financing gap. Financing gap. So financing gap. Let me write down. So you could imagine the nature of our business as a financial institution. So we have our assets, so the primarily loans that we give right to our clients, and we have liabilities. The liabilities would be core deposits, right? Predominantly core deposits. So we have let's say this is the average loans, right? This much, right? From here. So we have the average loans that we have, and then we have the average deposits. let's do the first example. This is an easy example. So the average assets or average loans exactly match our average deposits. Then in this case, there's no financing gap, right? No gap. Why no gap? Because the average loans perfectly match the average deposits that we receive. However, in real life, we hardly find this kind of the perfectly matched situation. So let's see now. What about if it's the situation? This is the situation. So this is the average assets, average loans that we give. The average deposits is only this much. So you see, right? The average loans is more or higher than the average deposit. So in this case, we have financing gap, right? We have financing gap. Okay, so now we have average loans minus average deposits. Okay, so we have can you imagine the financing gap, right? Financing gap. So the financing is not enough, right? It's not enough. That's why the financing gap is positive, because we need uh, this much average loans, but our average deposits is only this much. So we say that we have a positive financing gap. And moreover, a financial institution might be willing or might want to hold certain level of liquid assets. So again, uh, this is the average amount of loans, right, that we lend out, right, to our clients, right? But we also want to hold, right, a certain level of liquid assets. So that requirement add to this, right? Okay, so you can imagine. Now the financing gap would be even more, right? Because now uh, the gap increases because now not only do we have this gap between average assets and average assets and average liabilities, but we also want like additional or certain amount of or certain level of liquid assets. So we need even more assets, right? So we have the average loans that we lend out or we give to our clients, plus a certain level of liquid assets that we want to hold, and this amount is compared to the average deposits that we receive. Okay, so of course you could rearrange the formula, right? Okay, so you see here, so the borrowed funds would be this one, right? Right, to fulfill the gap plus the requirement, your desire to hold a certain level of liquid assets. Okay, so the gap has to be covered by the borrowed funds as shown here. Okay, so see the financing gap, right? Financing gap, and then now you not only do you have the financing gap, but you also want to hold uh, a certain amount of liquid assets. Then the requirement to borrow more funds increases as shown in our figure as well. So this is an example. This is average loans of 25, average loans of 20, sorry, average deposit of 20. So what is the financing gap? The financing gap is 5, right? And you also decide to hold like 5 liquid assets. Okay, so the gap, right? The financing gap is 5. So you lend out more money than what you receive from depositors, and you also want to hold a certain level of liquid assets. So in total, the required borrowed funds would be 10, right? 5 plus 5. Okay, I hope it's quite clear up to this point, because the next one, we'll see two important ratios here, ratios that have been endorsed by a lot of regulators in many countries, right? So the first one is liquidity coverage ratio, and then the second one is NSFR, net stable funding ratio. So two famous ratios here. So we'll see each of them. We start from LCR. So LCR, the stock of high quality liquid assets, or simply we can call it like liquid assets, divided by total net cash outflows over the next 30 days or 30 calendar days. So essentially, we are comparing, or we are dividing liquid assets by uh, the uses of liquidity, right? So the source of liquidity divided by the use or the uses of liquidity. So we see an example here. For additional information, the cash inflows over the next 30 calendar days will be 5 million, right? So cash inflow over the next 30 days will be 5 million. So let's see what they have here. This is a hypothetical example. So cash, I have the deposits at the Fed, deposits at the central bank. They have the government securities. They have the Ginnie Mae securities. This is buying the what's that? The mortgage-backed securities, a practice that is very common and famous in the United States. Other countries have followed suit, right? Many of the banks have started selling mortgage-backed securities, and we have some loans here to A-rated corporations, to B-rated corporations, and then we have premises like buildings and so forth, right? Uh, so to make the story easier for us to follow, uh, the liquidity levels have been informed. Okay, so in real life, of course, you have to find by yourself on the BIS website or some other sources, but in these materials they have been provided. So this makes us uh, easier to to follow the estimation and discussion. So if you notice here, uh, the more liquid, right, the more liquid the asset is, the higher the level is assigned, right? So level one, right? For level one is for more liquid assets. Level 2A will be like less liquid compared to level one, and of course level 2B, 2B is less liquid than level 2A, and of course level one. So it has been informed, right, in these materials, but again, in real life, you have to find by yourself, right, the leveling information on the levels of the assets. So what about the liability side or the denominator side? So we have run off factors for all the items there. Uh, Again, in real life, you have to find them by yourself. Yeah, you can go to BIS website and some other sources. But these materials have informed us the pieces of information about run-off factors, right? So if you notice here, stable retail deposit, less stable retail deposit, unsecured wholesale funding from stable small business deposits, less stable small business deposits, non-financial corporates, and equity. So if you notice here, the run-off factors or the run-off factor is smaller for uh, you know more liquid or more stable financing, right? So the less stable financing would receive a higher run-off factor because this is the denominator, right? The denominator. The higher the number, the worse, right? The situation is considered to be. Okay, so 3%, 10%, 5, as 75. The bigger run-off factor is assigned for non-financial corporations, whereas stable retail deposits. So this is the most stable source is assigned only 3%. Right? Okay, so let's calculate now the LCR, liquidity coverage ratio. Okay, level one. What level one items do we have? This one, cash, and then deposits at the Fed, call it a reserve requirement, right? Reserve requirement deposit and other types of deposits at the central bank. And then 100 is what the T-bills, right? The government securities. And the total for level one is 125. What about level 2A? Level 2A, we have Ginnie Mae securities. We have loans to corporate, to A-level corporate or A-rated corporations. Okay, and then so here's the thing, right? The level two will get a haircut of 15%. So we can only claim 85% of the amount. Right? So 50% cut, right, or haircut. See here, we can only claim 85% of the level two, both levels 2A and 2B. Also this one, right? The 85 here comes from this one, the B-rated corporations, loans to B-rated corporations. But again, for level two assets, we will assign a haircut of 15%. So we can only claim 85% of the amount. Right? Okay, so when we add them together, it's about, let me calculate. $57, 25 plus 72.25. So the total amount for level two is 229.50. Right. However, if you notice on this slide, the level two amount uh, has to choose. We have to choose the lower between this one and 40% of level one. So 40% of 125 is 50. So we have to choose, right? Which one is lower? Because the Basel Committee, the Bank for International Settlements, uh, tries to be more conservative. So again, the total for level two is 229.50. See the addition of this two amounts. But we have to compare the total amount with the cap, right? So it is capped at 40% of level 1. So level 1, we just calculated minutes ago, is 125. 40% of 125 is 50. So we have to choose, right? Which one is lower, 229.50 or 50? Of course, 50, right? That's why the one we choose is 50. So 125 from level 1 and 50 represents level 2. So the total of the numerator is 175. Yeah, right? The high liquid assets, or the numerator, the total for the numerator is 175, or the liquid assets, right? Okay. So what about the denominator, or the uses of liquidity? Right? Sources of liquidity, this part, the uses of liquidity. So let me. Okay, we already have the runoff factors for all. Okay, so we multiply each. For example, the stable retail deposit is having is assigned a runoff factor of 3%, right? 95 multiplied by its runoff factor. 40 multiplied by its runoff factor, right? So each item is multiplied by its respective runoff factor, and then we get this much, right? 57.35. And if you notice here, equity is not assigned any runoff factor, right? Because equity is super stable, right? Super stable. So we could say that it's 0% runoff factor. It doesn't get in and out easily or quickly, right? It's a part of the stable financing, right? But in a financial institution, remember that the equity level is relatively low, unlike in manufacturing or services firms. Okay, so the total is 57.35. Right now, we have to deduct. So this is the cash outflows. So now we have to deduct the minimum value. Minimum value means which one is smaller, right? Between cash inflows, sorry, or 75% of cash outflows. Okay, so again, our cash outflow is 57.35. So we have to minus. So which one is smaller? Cash inflows. So we see the information again here. See, cash inflows for the next 30 days are 5 million. So cash inflows 5 million, or 75% of this. So 75% of cash outflows. Let me calculate quickly. So 43.01 million. So minimum, right? Which one is smaller? 5 or 43? Of course, it's 5. Okay, so then we have to minus 5 instead of 43. So minus 5, right? So the minimum between 5 and 43 somethings. So 5 is smaller, so we minus 5, right? So 57 minus 5 is 52.35. So this is the denominator, right? The denominator, or the uses of liquidity. So again, one more time, right? LCR, right? This is the LCR. The numerator is this one, the highly liquid assets 175, and the denominator is this one, right? Total net cash outflows over the next 30 days, or you can name it uses of liquidity, if you want, right? So 334%, right? It's more than 100%, right? So we are saying that the liquidity position of this financial institution is relatively good or strong, right? So more than 100%. Okay, so that is LCR, liquidity coverage ratio. Then the second one, and this one is becoming more and more famous because many regulators in many countries start estimating and enforcing the requirement to manage the net stable funding ratio. So in this ratio, you see the numerator is, we call it ASF, so available stable funding, right? Available stable funding. So this is the we can call it what, sources of liquidity, right? Sources of liquidity, and the denominator is the required amount of stable funding. So required stable funding, so RSF, right? RSF. Okay, so let's go into an example. By the way, you see here, you can check on the BIS website, also on other related textbooks, right? So you see the uh, requirements and also the categories there, right? So you see the runoff factor, right? The all categories for determining or assigning runoff factors, right? So you can see, and the also the leveling. Let me find, where's the leveling? Maybe it's not here. It doesn't show here, but again, we can find all the required categories, both for the asset leveling and also for the cash outflows, run-off factors on the BIS website, and also other related textbooks. So now we see an example for the NSFR, net stable funding ratio. Okay, so we start from this one, right? ASF. If you notice, the numerator is ASF, or available stable funding, right? So ASF is the numerator. So you see the same thing here. We have the factors, right? Factors that have been informed us. But if you happen to estimate real data of your organizations, then you have to find again the funding factors on the BIS website or some other related textbooks, right? So 90%, 80%, and so forth. So if you notice, more stable type of financing is assigned a higher ratio. Why? Because this is the numerator, right? Numerator. So the higher the number, the more stable it is considered, right? If you notice equity is super stable, right? The most stable of all is assigned 100%, right? The stable retail deposit is assigned 90, and then the less stable items are assigned lower ASF factor, For example, non-financial corporates will be assigned only 50%. Okay, so we do the calculation, the ASF, this is the numerator. We just find the weighted average, right? So 95 times 90 plus 40 times 80 and so forth. And we get this much. Okay, that is the numerator, or ASF, available stable funding. What about the denominator? The denominator is RSF, required stable funding. Okay, this again is the denominator. Okay, so if you notice here, the factors. So the factor point is lower for more liquid assets. So this is like the other way around, right? Why? Because this is the denominator, right? The denominator. So the lower the factor, the more liquid the asset is, or the asset that it tries to show, right? So lower factor is certainly better here because this is the denominator, right? The something that you divide. Okay, so for example, cash is assigned at 0%. Deposit at the Fed is 5, right? Government securities is 5, and so forth. And you see the premises is less, or the least liquid, so we give 100% funding factor, RSF factor, because premises such as the buildings and some other uh, physical premises are the least liquid of all. So it's given at 100% factor. So the higher the factor, the less liquid the asset is, because this is the denominator. Okay. So again, we are doing the weighted average calculation, right? Multiply by each factor, and then we get the denominator. This is the RSF. RSF is the denominator. Okay, so we divide it, right? NSFR. This is the numerator, right? The numerator divided by the denominator, or in other words, ASF divided by RSF. Right? Available stable funding divided by required stable funding. So we get 228%, which is much higher than 100%. So again, we are saying that this financial institution is relatively safe and robust with respect to its liquidity position. Right? And then you can see the details, right? Is the ASF, and 100% will be assigned for certain things, right? ASF, again, is the numerator. So the higher the number, the higher the factor, the more stable the source or the financing is. On the other hand, you can see the RSF. This is the denominator. So the lower the factor, the more liquid the asset is, right? Like cash, some unencumbered securities. Unencumbered means no restriction, right? No restriction, unencumbered. And see, 100% is assigned on premises and some illiquid assets. Okay, so we have seen some measurements, right? Some measures of liquidity risk, and you see the the end of our discussion, and we'll talk about liquidity planning. So planning is of course important, right? Not only in the field of like liquidity risk, but also in other things, right? Planning for strategic analysis, planning for production, financial planning, and other things. A key component in many things. including the liquidity risk or liquidity position, right? So more, see here, so before liquidity problem arise, uh, so we should make, or we should have more funding decisions. So we start making a list, right? If something happens with respect to liquidity, uh, what sources can we access, right, to borrow quick borrowings, right, or quick debts that we could get, okay? Identifying optimal funding mix, right? Again, as a financial institution, of course, we mostly count on the core deposits, but again, because of the tougher competition, right, more again stiffer competition, then we have to think about other sources of financing as well, like commercial papers, bonds, and some other things. And also, we need to minimize the need for excess reserve holdings. But this decision will depend on the regulation in each country, because certain countries require a very high level of reserve requirement plus excess reserve, while other countries require a very low level of reserve requirement. Delineate managerial responsibilities, right? Need to identify who responds to regulatory agencies, who publishes information to the public, and so forth. Right? Detailed list of funds providers. We talked about this, right? And important it's important to anticipate the expected pattern of withdrawals in a crisis. So we know that when there's a rumor about a crisis, or the crisis is looming, then of course people will be quite uh, worried, right? Okay, and the the worriness will create panic, and there's a possibility of bank run or rush in any kind of financial institutions. Also, seasonal effects that we have seen in the beginning of this discussion. Okay? But again, under normal condition, financial institutions could uh, make projection or could estimate relatively accurately about the flow of money, right? The incoming cash flows and also the outgoing cash flows. However, again, in the crisis situation, especially if it happens quickly, then we might be running out of time, cannot catch up with the requirement to save the liquidity position. So identify the size of potential deposit and fund withdrawals over various future time horizons. Again, this is we just the thing that we just discussed, right? So uh, in like regular months or in normal economic situations, we could actually forecast quite accurately. Certain dates will see uh, a lot of money coming in, right? Because they pour out money, they put it into the banking system. On certain dates, we have to disperse money because of the salary payment or repayment of debts and some other things. However, again, in a difficult situation, the crisis, political turmoil, and other delicate situations, then it becomes out of touch, right? Out of control. Then we cannot estimate anything, cannot forecast anything accurately anymore. So the thing that we can do is to rely on the liquidity planning that we have set before, and we have to implement the emergency plans or emergency plans during the difficult periods. Set internal limits on subsidiaries and branches borrowings. We set the limits for them, right? Cannot uh, exceed certain limits. And of course, we could plan the sequence of asset disposal when or should the liquidity risk arise. Okay, so we start making a list, right? Which assets should we should dispose first, and which one the second, and so forth, right? The sequence of assets. Of course, we start disposing least important, least consequential assets, and then followed by again the second least consequential assets, and so forth. So bank runs, right? This could arise due to concern about bank solvency, right? Maybe there's bad news at bank solvency, the clearing problem, right? Clearing problem, uh, rumor about a bank, right? So solvency means this is like uh, close to bankruptcy, right? It's just insolvent, so cannot pay, cannot fulfill its obligations, right? Cannot fulfill, be it like liquidity or liquid assets or the long-term assets, so insolvent, right? So worse than illiquid position, or worse than liquidity problem, because this is a solvency problem by the whole breakdown. But interestingly, you see the second one, failure of related financial institutions. So this is quite true in the financial sector, in the banking uh, industry, right? A problem suffered by one financial institution could be, well, uh, could be interpreted as a problem in the whole financial system or financial industry. So this is the danger, right? Very dangerous situation. So you could imagine several years ago, for example, in Indonesia, the uh, the governor of the central bank decided to bail out one particular bank. And the main reason, right, the main argument of the governor at that time was to avoid the systemic risk, right, or systemic, interpretation by investors, by economic players, right? Okay, so this is so true. So in the financial industry, financial system, again, a failure of one financial institution could be considered super bad news. Then everybody, uh, such that everybody or every depositor will immediately queue in front of their banks, right, to withdraw money, right? So that's called a bank run or bank rush. Right? So it's very important to manage the information, because again, the interpretation of information is quite uncertain and wild, especially with respect to the institutions that manage the flows of money, right? And sudden changes in investor preferences, especially during the crisis period, they prefer to hold gold, cash, uh, foreign currencies, and some other, like super liquid assets at their hands. Okay, so they might want to go to their banks to withdraw money, maybe 90% of it, 75% of it, and then uh, what's it, to translate or to change the money into maybe gold or foreign currencies and some other assets. So here's the interesting question, right? Why is the run more likely to happen to banks rather than other financial institutions? For example, mutual funds or some other things, right? And of course, the answer is quite psychological, but also, of course, financial and legal. Okay, so let's imagine that this is a bank, right? It receives deposits, right? Receives deposits, and then it channels out the funds. It lends out the funds to entrepreneurs and businesses. So if something happens to the bank, see, right? We know that there's a certain bailout by the FDIC in the United States, right? The Federal Deposit Insurance Corporation. The name would be different in every country, right? This is the uh, entity or unit that guarantees depositors, right? The money of depositors. So, for example, the FDIC would guarantee up to, let's say, 250,000. In other countries, the amount will be different, right? For example, in Indonesia, we have the LPS. Right? LPS will guarantee up to 2 billion, right, per account. But again, imagine the situation, right? We have a long list of depositors, right? So if something happens to the bank, it will have to liquidate its assets, right? Liquidate its assets means uh, they have to cash in or resell the loans to other buyers, right? Maybe they're doing the factoring type of activity or action, right? So they have to sell the loans to other buyers. They have to sell their physical assets and so forth. So with the amount of money that they get from the liquidation, then they use the money from liquidated assets to pay their creditors, right? The depositors. However, you see the situation, they may not be able to collect 100% of their assets, right? Let's say they're only able to collect maybe 50%. Here's the complicated situation, right? They only have like 50% of their assets, right? So they have to pay their depositors, right? So who will get the money first? Of course, the person who comes first, right? So let's say you are a person number 1,000, okay, and actually your deposit in the bank is quite small, maybe only uh 20,000, okay. So you only deposited 20,000 in the bank, and remember, right? FDIC will guarantee up to 250,000. So actually, you have no problem, right? Because uh, although you're person number 1,000, but your deposit amount is not that high, right? 20,000 is still below uh, the limit set by FDIC. So it's not a problem for you. But what about this? You are person number, let's say 100. So you are closer actually to getting the money. However, you are having let's say 1 billion deposit, 1 billion deposit in the bank, right? And you see here, you're person number 100. So you have 99 people in front of you queuing for the money, right? And you never know, maybe when you get uh, your get your spot, or uh, it comes to your uh, spot here, number 100, the bank is running out of money. So what can you get is only the guarantee by the FDIC, right, of 250,000, and you lose maybe almost all of the remaining amount. So this creates the urgency, right, the appetite for depositors to wait in front of their bank's branches if there's such a crisis. So they'll go and they want to withdraw their money as soon as possible. So you see the situation again, right? If you are on the queue in a certain on a certain number, certain priority, so you have to wait until all other people in front of you get served, and they might get like 100% of their money. They might get only 75%, depending upon the available money that the bank has or could collect is liquidated assets. Okay, so that's why bank is more prone to to run and rush, right, compared to other financial institutions. So you can imagine another financial institutions such as mutual funds, right? Let's say you bought a mutual fund unit at any value, 1,000 per unit, okay, 1,000 per unit, and let's say you bought 10 units, so your investment was 10,000, right? 10,000. So another colleague of yours, the same thing here. He or she started with 1,000 per unit, and she bought, let's say, 20 units. So her investment was 20,000. Right? So suppose that a crisis comes, right? A crisis attacks the country. It attacks all financial institutions, and suddenly, because of the crashed capital market, the 1,000 per unit, the value of the mutual fund unit drops to, let's say, 500. So it drops 50%, right? So how much is your wealth from that investment now? 10 units. So your money or the value of your mutual fund is now 5,000. What about your colleague from 1,000 to 500 with 20 units? So her wealth is now 10,000. You see, why don't you go to the door of your mutual fund and claim the money immediately? You don't have the urgency or the necessity to do it, because everybody will suffer from the same proportionate loss, right? Proportionate loss. So you're losing. See, if the mutual fund is losing 50%, then of course your wealth drops by 50%, and her wealth drops by 50% as well. So nobody is losing more or less than 50%. It's very different from the bank situation again. If you follow again, we have to queue. Why we need to be in line as quick as possible, because we are not sure if we are person number 100 here, the uh, queuing number 100, we are not sure how much money remaining possessed by the bank, right? Even if we are quite close uh, to the first number, we are only number 100, but we are not sure. Maybe 99 people in front of us already got 100% of their money. So when it comes to you, maybe the bank cannot afford to pay 100% anymore, especially if you have a big investment such as like 1 million or tens of million or something like that. Okay, so again, bank is more prone to run and rush because of that fact. Right? First come, first serve. And also bank panic, right? Systemic or contagious bank run. So if the problem happens to another bank or another financial institution, there's a high chance that we will experience some sort of run or rush, maybe temporarily or within a short period of time, because many people will be worried about their money, right, in the banking system. So alleviating bank runs. So measures to reduce the likelihood of bank runs. Of course, we have the deposit insurance. Uh, this is related to this one. FDIC in the United States, another name in another country, of course, the Federal Deposit Insurance Corporation. And the discount window, uh, a bank could have an access to the liquidity lending from its central bank, right? The central bank in each country, the Federal Reserve in the United States, right? Or we might expect like direct actions, right? Such as the Troubled Asset Relief Program in 2009. Right? It's a Troubled Asset Relief Program. The program uh, made by the enacted by the U.S. government. Uh, this is actually it was during the transition from President Bush to President Obama, the TARP in early 2009. So many financial institutions and also depositors and investors believe that uh, every government in the world will consider financial institutions or the financial industry to be too big to fail industry, right? Because financial industry is usually functioning as the pillar of an economy. So many governments, or almost all governments in the world, will consider the financial industry to be like a too big to fail industry. Right? So we would expect like government intervention or government bailout should something happen to the financial sector or the economy as a whole. And of course, not without economic costs, right? If protection is higher, the deposit insurance program is more extensive, then many banks will see this as an opportunity to increase their risk exposure. Okay, so this is about the liquidity risk, and I think one particular measure, important measure, created by every central bank in the world to help curb the potential liquidity problem is uh, the reserve requirement. I will talk a bit about this before we end our discussion. So reserve requirement, right? So reserve requirement, and the ratio or the rate would be different from one country to another. So reserve requirement means this is uh, the proportion of your core deposits that has to be put or saved in the central bank, right? So the money that you have to put in the central bank as part as a percentage point of your core deposits. So again, the rate would be different from one country to another. In the United States, I believe is 10%, 10%. So you could imagine that uh, if you receive core deposits of, let's say, 10 billion, then 1 billion of it, 1 billion of it has to be set aside or has to be put in the central bank as a reserve requirement. However, of course, in the world we are not using the contemporaneous method. So we are not using this contemporaneous method. Right? So we are not comparing the amount of reserve requirement daily compared to the amount of core deposits on that day. So we are not implementing the contemporaneous method, but we are using the lagged method, right? So lagged method in many countries uh, they are using like the a 2 week lag to calculate the reserve requirement. So we're saying that, for example, we have uh, 2 weeks before, 2 previous weeks, and throughout the week we have average value or average amount of core deposits. Okay, and then 2 weeks later we start counting, right? So on this particular day, so the ratio should be yeah, anything. Maybe, for example, in In Indonesia, the reserve requirement is 6.5. This is the total reserve requirement. So we could roughly say that 6.5% of the core deposits has to be put in the central bank as reserve requirement. However, this has like several detailed components. For example, the average primary reserve requirement, the averaging style might be 4%, okay, but the total is 6.5%. Okay, so every country has different arrangement and calculations, right? So in essence, we are saying that 6.5% is the total reserve requirement, while the average primary is only 2%. So it averaged 2 weeks ago is the basis for the estimation or the calculation of the reserve requirement. Another example in Germany, I think the reserve requirement is relatively low. It's about 1 to 2%, maybe 1% right now. So you see, every country will enact or will pass different policy, right, on the reserve requirement. But again, the uh, the salient purpose of enacting this reserve requirement policy is again uh, to improve liquidity position, right? To prepare financial institutions to pay more attention on their liquidity positions and to prevent themselves from getting into liquidity position problem. Right? Okay, so I think that's all for our current discussion on liquidity risk. Of course, I'm sure you have many questions, so we can discuss on the channel or on other means of communication. And thank you very much for watching and learning together. So I hope to see you again in other topics in finance and economics. Thank you and see you.